Started. Good morning, everyone. I hope everyone had a nice, relaxing night. I got to catch up on some sleep and rest up for today. Just a couple of announcements before we get started. As you know, we're live streaming the conference, and yesterday we had 137 people watching from afar. So there's a large audience who is watching. So that's great. And anyone who's watching right now, thank you and welcome remotely. At lunch today, we're going to be doing a demonstration of a board game that one of our research teams, led by Andrew Crawford, here, wave your hand, has developed really as a tool to help understand how ROSCAs work and as a tool to spark conversations about money management in groups. So there'll be a demonstration of that. A couple of you have played an early version of this game before, so it'll be a lot of fun. We can all watch and enjoy while we're eating. Also, we've had a number of requests for copies of the Consumer Finance Research Method Toolkit, which was just released, and it is available on our website. But what we're going to do by the end of the conference is get one black and white copy of it for each research team. So you've got that to take away if you want to, put it in your luggage and take it away. So we will have that. Now this morning's panel is called In Blank We Trust, the Contingencies of Social and Financial Protection. And we've had a number of discussions over the past years at IMTFI about this question of trust. What is trust anyway? Is trust a thing that's just sort of between two entities, whether it's two individual people or a person in a company or a person in an infrastructure? How do we think about it? And the presenters today, all in different ways, are going to touch on this question of trust. But I did want to call your attention to a recent synthetic piece that we did at IMTFI based on the insights of prior IMTFI research. And this is in the back, and you're welcome to pick one up. It's called Trust and Money. It's complicated. And we use examples from the research over the years to go through various issues around trust and trustworthiness and trust, technology, and money. And I want to sort of call out our postdocs, Ursula Dollinghouse in particular, and Minu Tanka, and the graduate students who helped to put this together. And again, also to acknowledge the IMTFI researchers whose work went into this thing. So take a look. It also is online if you want to see an electronic version. So we're very fortunate to have as our moderator here today Kate McKee, who's a senior policy advisor for responsible finance and graduating extreme poor households into sustainable livelihoods at the Consultative Group to Assist the Poor, or CGAP. She joined CGAP in 2006 and leads their research and policy advisory work on consumer protection and responsible finance. And at IMTFI, pretty much from day one, we've been like, consumer protection, this is an important thing we need to be thinking about, because I think in the early days, it often wasn't necessarily put as front and center as it needs to be. So I'm very, very pleased that Kate could be with us here, and I'll just turn it over to you. Thanks.
Great. Good morning, everyone. Good morning, everyone. I was just thinking of what Bill said about 137 people viewing this yesterday. I wonder how many of them were there at 9 in the morning. Maybe not so many, but let's see what kind of audience we can attract. So you will be preparing your questions for our excellent panel, who I'm going to introduce in a few moments. But first, we have a few questions for you. So, how many of you have bank accounts? Really? You don't have I'm looking at someone who looks like he's Indian. I can't imagine you don't have a bank account. Yes, there we go. All right. How many of you trust your bank? Exactly. In what way? Okay, so you trust your bank to keep your money safe. Yeah, safe. You trust your bank to treat you like a respected customer. Maybe not quite so many. You trust your bank to quickly, without too much hassle to you, resolve some problem that arises in your account? Well, that's pretty good. I mean, a third, maybe. Not too bad. Okay, let's try just a few more of these. How many of you have one or more insurance companies? Insurance policies? Okay, do you trust your insurance company? Do you trust them to keep the money safe? Okay, the customer service question? Not so much. The paying out a claim in a timely fashion? Wow, I need your insurance company. Do you work for an insurance company? No. All right. All right. Credit card company, trust. How many of you have credit cards? You trust that they account well and they don't try to do any tricks. Oh, well, the trick part kind of brought down some hands. Okay. How many of you, you don't have to raise your hand, but if you have a spouse or partner, do you generally trust them with your money? Oh dear, I'm glad that there's not that the cameras are on us instead of on all of you, because your spouse might be one of the 13 people watching right now. Okay, so I want you to just think a little bit. We're going to get our minds wrapped around trust, and it's in blank we trust, in whom we trust, in which practices we trust, the sources and manifestations of trust. And this will be in the context, obviously, of financial inclusion, and particularly digital financial inclusion in countries around the world. So I found the video yesterday extremely powerful. I would really like to see the whole thing. And to me, it had one of the images that it put front and center was crossing the border and recrossing the border. And when we think of use of formal and informal financial services, clearly it's a border that gets crossed and recrossed, and where we've got different things in our pockets at different time and different expectations and goals we're trying to pursue. So this is very much not binary. A concept that I found really helpful, and again, in thinking about what you're about to hear here, is the one that's in this great trust publication, which I highly recommend that you take a look at. And it's a distinction that Deepti was bringing out also, and it came out in several of the presentations I had the opportunity to hear yesterday, on the difference between the knowledge side and the trust side of deciding to take up, use, continue to use in more complicated ways, different kinds of financial instruments that we have. And so there's the knowledge about, how does it work? And that's tied up also with confidence in my ability to make it work, and with a really important issue of whether this is a direct use of a financial service or if it's mediated in some way through some kind of intermediary, which is another concept. But it's basically about know-how, and that's quite different from whether I actually think that I know how it is supposed to work. Whether I think it will work in that way is really a really different concept. And that one of the images, again, that was coming out of the two panels in the afternoon yesterday about, do you know the rules of the game? Do I know how it works? I know how it works traditionally in informal financial arrangements. And it's possible that formal, work better, are more transparent, or more reliable, or, better value for money. But I don't know the rules of the game. And that is something that is more about trust maybe than knowing how a service works. And so in our panel today, we're going to be hearing from very different settings, from Myanmar, India, Nigeria, Colombia, and from people who are using formal finance and digital finance in many cases for the first time, and not always by choice. So when we think about the case of social protection, You know, this is a sort of a mandatory use in many cases where the government has said, now, because it's more efficient, you're going to receive your benefit this way instead of with the cash truck coming around. And so we need to think also about how that, you know, lack of choice may play out in terms of trust and knowledge. So, and then one final point, and these are sort of the questions which I think the panel will be addressing, and where we might want to explore in our discussion session afterwards, is we have these core issues around trust of formal finance, and then when we layer on the digital aspect, how does that change then the different dimensions of the know-how and of the knowing whether something will deliver as promised? So I want you to listen for a few issues. What are the drivers of trust and mistrust? The role of the state is actually quite important. We have, in most of these countries, the government has decided to drive financial inclusion and digital financial inclusion. So how does that affect trust? The mandatory nature of being formalized, as I mentioned. The relevance of views of financial service providers on these issues and their perception about how whether trust is important, how it can be won, whether their brand and reliability is enough or not. And finally then listen for the methods, the research methods, because this is a really, maybe it's such a core issue, trust, but so tricky to get at and really requires triangulation with different techniques. So what we have today, I'm not going to go into all the bioinformation because you've got that in the book, but we're going to lead off with the role of mobile money and social protection networks in 2 rural areas of Colombia. And we have with us today Andrea Beltrán, who's part of the research team from the Universidad Externado de Colombia. And then we will have joining us on Skype, because she's very pregnant, expecting to deliver a child shortly, the principal investigator, Maria Elisa Balen. So don't make your questions too tough. We don't want to drive her to the delivery room. And then we're going to hear from the Olus, from Oludayo Tade and Oluwatosin Adeniyi from the University of Ibadan in Nigeria, which was my adopted home for 3 years. Not the university, but Nigeria. So we are hearing from the epicenter of mobile money fraud. And we're going to hear about how this kind of context, I thought yesterday the points about South Africa and the crime environment and how that affected trust are relevant also to what we're going to hear today. But there's, I think, some optimistic news in your research as well. And then we're going to hear from 2 really contrasting places, Myanmar, where mobile is penetrating super fast, and mobile money was really just authorized to start about a month ago or so. And from India, where frankly everything in financial inclusion has been tried, and we're starting to see now some uptake of digital finance and mobile money, and things could change really quickly. So in each of these settings, we're going to be looking at the context of the people who are making that decision whether or not to cross the border, who are trying to acquire the knowledge they need and the trust they need to transact. And I can't wait to hear about it. And Andrea is going to kick off our session. Thank you.
Thanks for being here. So, first. So, our research is called The Role of Mobile Money in Social Protection Networks in 2 Rural Areas of Colombia. We are 4 researchers, and my name is Andrea Beltrán. This is the outline of my presentation. I will give a general overview, but if you have more questions, my colleague, Maria Elisa Balen, will be available on Skype at the end of the panel. So, the first part deals with the context of our research, why these rural areas and why mobile money. The second one deals with the methodology, and in the third one, I will present an example of our research so far. So, These are the two areas where we are carrying out our research, Montes de Maria in the north and Putumayo in the south. More specifically, we are carrying out our research in two cities, towns of these regions, El Carmen de Bolívar, a central municipality in Montes de Maria, and Mocoa, the capital of Putumayo. As maybe some of you know, Colombia is in an internal ongoing conflict now for more than 60 years. And as a result of that, Colombia has 6 million displaced people. In fact, Colombia is the second country with the highest number of internal displaced people after Syria. In the case of Mocoa, for example, okay, the two regions, or better, the two cities have received a lot of this population. In the case of Mocoa, for example, in the Putumayo, Mocoa has a population of 40,000 people, and 26 are displaced people. That means more than half. This is Putumayo. This is Montes de Maria. And so we are interested in social protection practices, in the social protection practices of the families. These practices result, to some extent, of the relation of families with the economical opportunities that brings the market, and with the relation with the states, policies, social policies, not social policies. So, in both relations of the family with the market and the relationship between family and the state, families have faced important change in the recent years. Regarding the market, the economical opportunities, families in both regions have faced important challenge in the way that they can provide for themselves. In the north, because of the decline of the tobacco production, because of the war, and in the south, because of the ups and downs of the market of the illegal coca crops. Regarding the state, families have faced also important changes in the recent years. The state has become more present in these areas. The state has intervened through its war apparatus, through military forces, but also through social policies. Among these social policies, cash transference has become the most important and the most extended one. And state do that through mobile money, most of the time. So in this context, with this change in market, with this change in state, and with this change in family themselves, because most of them has become dismembering or separate, mobile money becomes relevant and becomes an interesting object of study. Because state send money by this means, and because family has to reconfigure over a large distance, and mobile money can play a role in it. And also because most of these families that we are talking about are displaced, and from rural areas to urban areas, and as you know, money becomes more relevant in in urban areas than in rural areas. So in this context, we ask now what are the role of that mobile money is playing in this specific context in conflict zone, and what is the role that it can be played in the future. So our methodology. There are two important points about our methodology. The first is that we are using two kinds of decentralization in order to approach practices, social protection practices of families, and in order to approach money. The first one, we are looking to understand practices in past, present, future perspective. not only the present. I will explain more further. And we are looking to understand how money circulates in the context of other circulating goods, goods and services. I will explain later. And the second thing that is important about our methodology is that we are looking for an approach that allows us to deal with diversity in conflict zones. For example, we are contact people through snowballing practices, someone who knows someone, but also we are looking for diversity, and in order to reach that, we are trying to use different entry points. For example, we are talking to people in the line of bank agents, or we are looking for people in different areas of the rural areas. And in order to avoid a normative perspective of what family is, our point of departure is what people think that family is, what family is for themselves. We are not, our point of departure is not a fixed notion of what family is or should be. So, our methodology has three main components. The first one, getting to know the mobile money ecosystem. We are doing that through interviews with whom? With government functionaries and with bank agents at the national, but also at the local level. The second one, the second component, is to generating joint reflection with families about the past, about their past and present practices regarding social protection, and about their perspectives about the future. How we are doing that? About the past, we are doing that through interviews or informal conversations. About the present, we are applying some exercise during different days so that families can reflect upon what they are doing. And one kind of this exercise are family maps. I will show an example to you in the next slide. And about the future, we are interested in two dimensions, in the idealistic dimension and in the realistic dimension. So we are asking families, we are asking people how they think the future will be and how they want the future to be. And we will do that through exercise like storytelling or drawing. And the final component of our methodology is a socialization workshop. We will do that with all the participants in our research, and we want to present our results, but also to discuss the result with them, but also the perspectives, and to maybe to explore some questions that we will have at that time. These are the people drawing the maps. This is an example of a map. We are looking for how goods and services are circulating. This is, let's say, Sandra, 38 years, and housing circulating in that way. She gives, but she receives also from siblings, daughters and sons, friends, and niece and nephew. Care. We're asking also for care, for advice, for food, for money, just to some of her needs, and for union. We ask, in fact, people to draw other things, whatever they want. In this case, Sandra chose union, and they draw union with a lot of the members of her family. And These are three initial insights of our research. The first one is that the amount of money circulation within families has changed in both directions. It's mean, for some indigenous families that now are people living in the city, because it was non-money, and now there is money. And it is not a new thing, but they have to deal with it every day now. Before, it was not the case. And for other people, more like peasant families, for example, in the south that were in the coca market, they have a lot of amounts of money. And now they are displaced to the city, and they don't have that same amount of the money. So money becomes relevant in a different way for these families, for these displaced families. Well, we know money is just one part of a wider web of exchange that have to accommodate two issues of geographical distance when families are dismembering or separate. And this is quite interesting. Mobile phone, and it's something that we will try to answer in our research. It's just an insight. Mobile phones are quite present in practice of family support, but mobile money is mostly associated with government payments. For the moment, there doesn't seem to be a technological spillover so far. So people are using mobile money in order to collect the payments of the government, but not more than that. And we want to answer why. Okay, thank you so much.
Thank you. Now we'll hear from Tade and Adeniyi about Nigeria. And I don't know how are you presenting together? Great, okay. Do you want one of you to have a microphone? Okay. It's okay.
Okay, yeah, good morning.
Good morning.
Well, it's nice to be back in Irvine. I think it's this kind of avenue to watch several thousands of flowers bloom at the same time that creates a special experience with IMTFI conferences, speaking from the perspective of an economist. So it's nice to hear things that anthropologists do and pick lessons from that also. Okay, so quickly I would speak a bit about how we got here, make a few statements about our previous project and how the lessons from that first project has led us down this road of thinking more seriously about trust and the implications of trust for the maintenance of financial ecosystem. So in 2013, we were mostly interested in automated teller machine fraud, which was a big issue back in Nigeria at the time. And two key questions we tried to answer. One, we tried to find some means of characterizing the fraudsters. And then the second point was that we tried to also look at how the experience of victimization affected the life chances of those who got victimized. Okay, and then we found, for instance, that the fraudsters were mainly kith and kin, family members. That has implications for interpersonal trust and issues within family, spousal trust, and a number of other issues. And then in terms of redress mechanisms, we also found lapses, and that led us to think more seriously about how trust is governed, even in terms of customers and providers of financial services, either they be banks or agents of some of these financial service providers. So here we are broadening our view to look more deeply at wider dimensions of fraud beyond just automated teller machines. And then more importantly, a critical part of what we've done is to try, maybe we're not there yet fully, but to try to understand in some deeper sense what trust means in these settings and also to think about how trust building can be done, okay, and how those mechanisms can facilitate financial inclusion, which I guess is the ultimate objective. So I would quickly go through the motivation for this new study. I would speak a bit about our methodology, what we've done so far, and then I'll leave Dayo, my colleague, who I think is more qualified to talk about the stories from the field, to deal with those details. Okay. Yeah, so, the environment in Nigeria has evolved in terms of this idea of cashless. And at the time we did the first study, it was just at the pilot phase, just about 5 or 6 states in the country. But by 2014, it was rolled out to all states in the country. But what has what has come as a consequence of that is also this increased incidence of fraud cases. And the Nigerian Deposit Insurance Corporation, which insures the deposits of people who keep their monies in these banks and places, has an annual report that shows the trends, and then not just in number of incidents, but also in value terms, what these losses are in terms of fraud to banks. And a quote by our former central bank governor saying that it's comes with some level of risk. Okay. Now, trust underlies customer bank relations, as I've said earlier, and when there's a breach, that has implications for issues like adoption, like use. There are cases of those who were using, but based on a breach of trust, are now a bit more dissociated, okay, from the ecosystem. So there's like an avoidance kind of behavior that comes as a result of a breach in trust. Okay. Yeah, so these technologically mediated transactions provide opportunities for deviant behavior, and that is evident from maybe our earlier study. Now, so there's a need for us to understand better the dimensions of fraud, and then the mechanisms that are in place to govern trust in our own peculiar ecosystem, where there's an environment where you have a huge population of young people who are technology savvy and also dynamic in the sense that they deploy their energies, okay, whether for the right or the wrong reasons. Okay, so the key questions we are interested in are to understand the dimensions of e-fraud, okay, to also learn a bit about the strategies used to defraud, and then importantly, the role that trust and the governance of trust play in adoption, and then mechanisms that are in place to also engender trust in the system. In terms of our research setting, we have kept it around our sphere of influence, and we are working in 3 states in Nigeria, Oyo, Ogun, and Lagos State. It's essentially an exploratory design, and we have done a number of key informant interviews with victims of fraud, bank officials, our National Economic and Financial Crimes Commission, and then the committee of the compliance officers of most of the deposit money banks in Nigeria. They have an association that meets at regular intervals, and we've had privilege of sitting in those meetings and hearing from them. Content analysis we have done, and also crime scripting, particularly from the cases that were given to us by the Economic and Financial Crimes Commission. So I'll let Dayo speak to some of the things that were found from our fieldwork.
Thank you, Tosin. Now, from the field, in terms of the first objective, we found that the dimensions of fraud can be categorized into three. We have the internal dimension, and when we talk about this internal dimension, it's talking exclusively by the type of fraud that are midwifed by staff of the bank, and they compromise, either compromise the data of the bank, use their technical know-how to manipulate, and then make certain cash transfers into their own account at the expense of the bank. In other words, the summary is that in our study, we found out that banks are also victims of this fraud. And so even those that work with them are also part of these fraudsters. And we have interesting cases where a particular operation head of a particular bank so much trusted a new guy that was employed. And because of its technical know-how in terms of solving technical issues, whenever she had problems, she would invite the guy, and then the guy will solve a problem for her on her laptop. In so doing, he was able to get the password to that particular system, and then worked with one of the cleaners who had exclusive access to this particular office. And so they arranged with the cleaner in that particular branch and gave her a key logger, which was later inserted on the system. Also in connivance with those people at the ICT unit, because the investigators who were after this particular case could not trace that the particular system where this particular fraud was carried out. And at the point they realized that they had disconnected a cable which could actually show where that particular system where the fraud was actually carried out. And then the money was wired into the guy's account, and this was later sent out. We also found the external dimension, which involved those that are outside the banking system, and these we have several examples which I will show in slides after now. And then we have collaboration between those that are within the banking sector and those that are outside the banking sector. And they work in such a way that those that are outside the banking sector, and what we found out from this, our study, is that to plan a particular fraud episode takes a longer time. Most importantly, when they are targeting huge funds. And so it is well planned, executed, and then they also monitor the routine activities of the bank, for instance, ensuring that they carry out this fraud on a public holiday where little or nothing can be done to stop the transaction, the wiring, or the arrest of whoever was involved. And so we have this collaboration also from our criminal partners from within the bank. This is almost a common scenario within the cashless ecosystem within the country. I do not know whether one of us in this room experienced receiving an alert on your mobile phones that you did not make any transaction. And people actually experience this kind of surprise debit alerts. You have not made anything, yet a certain amount of money has been debited from your account. And so this, it goes further to show that we have different types of fraud strategies that people are now deploying, apart from where we started in 2013, where we found these. And it's also, some of them are reoccurring. We found the issue of ATM fraud, in which people, from the bank staff perspective, they accuse customers of compromising their personal identification numbers, PIN, and rather than taking the blame of not putting the necessary infrastructure in place, where we can also detect those who have come around to make withdrawals on your money. We also found that lovers are also involved in this. A particularly interesting case was some couples, they were to become couples some few weeks time, and then the guy went, took the lady's card went and made some withdrawals. Unfortunately for the guy, the lady was on alert. She subscribed to the alert type to receive messages of any transaction on her account. It was during this process that she got the alert, and a huge amount of money had been withdrawn from her account. She went to the bank and then started accusing them of defrauding her. Fortunately, in this particular case, they were able to capture the identity of the person who actually came to withdraw. And lo and behold, it was the person that she would be lawfully wedded in some couple of weeks from that particular date. What then happened later, the bank disconnected with the case because they did not suffer any risk involved, and then they went home to make it a family affair. We also had cases where husband and wife had issue about trust, and we are concerned because one of those marriage counseling things that they will tell you in most churches and mosques is that you do not need to hide anything from your wife. Her husband should love their wife, you should be open, and the rest of them. And we are saying that when it comes to the issue of finances, and I was laughing when the discussant was introducing the thing and asked us in the hall, how many of you would leave this for your wife and the rest of them? And then we saw the responses, and I was telling my partner, and I said, yes. And it's confirmed here. And so in this case too, the husband, this was a big businesswoman who also had ATM card, and she left her card in the bag. The husband went, made the withdrawal, also some huge amount of money. And the woman went, and because she is a big customer, the bank had to pay special attention to appeal to her so that they go through investigation and check their system. At the end of the day, the husband, one funny thing was that the husband actually followed the wife to the bank again to harass the bank and accuse them of defrauding his wife. Ooh. At the end of the day, the printout from the CCTV camera showed the husband, and then they left the banking hall in shame. We also found cases where son defrauded the father, and in which case the son was to go to school, and then there was no cash. The mother was not going to give this boy any amount to go to school, and so this loving father, in quotes, handed over the ATM card to the son and gave an instruction: withdraw this amount. The boy went ahead and exceeded what the father asked, not knowing that, thinking that the father was a semi-illiterate driver, would not go to the extent of subscribing to email alerts on the account. And so before he returned the card, the father had received alert that the boy withdrew twice the amount that he was actually asked to withdraw. And so we have cases like that. And because of this issue of ATM fraud, we decided to also go to check ATM galleries and see relationship around these places and how people are compromising their relationship and taking things for granted. And if we look at this particular case, is more or less like a shoulder surfing, looking at whatever PIN that the lady is using to access the account. The same also goes for this case. And then you have also here almost 3 people making withdrawal at the same time. And then you have this type of fraud now, fake job scam. What is done in this particular case is that you would realize that in Nigeria now you would hear that a particular security agency arrested a particular man with almost 70 ATM cards. And you wonder how this particular person came about this ATM card. What is done is that an advert is placed out, and then they ask people to apply. Once you apply, they ask you, one of the conditions is that you open a bank account. And once you open a bank account, they collect your ATM card, an indication that you won't run away when you start the work. And then they give you about 5,000 naira, and then they ask you to check back at the end of the month. So they assemble all these and then distribute it across their network. At the same time, they are working with somebody within the bank who would give them the sign of when to strike, because they are already working on a particular account. And then once the money is, when the time or to strike comes, they just wire the money from the account and then send it across all these different accounts, because they already have the PIN of these ATM cards. And so it is withdrawn almost simultaneously, and nobody can trace and then get anything from this type. So you have it. And then you have uncredited lodgement as a fraud strategy, where people will take money to the bank account, rather than, instead of them to receive alert on their account, they won't receive it for days. Banking officers will connive with other business concerns, and then they will use that particular person's money and then return it maybe in 2 weeks' time. For those of the customers who do not have alert on their account, they have been victim of this type of fraud. And one interesting thing is this BVN, or what we call policy fraud. At a particular point in time, the government made it mandatory that all of us must register and get a biometric verification number to secure our account. And so many people rushed to make such registration. Unfortunately, not all those people who have bank accounts knew what they were doing. And so, because of this, the fraudsters started devising means, and they were sending text messages for you to click on a particular link from your mail, and then you supply your details. And through this, many lost millions of naira. Now, on the other side, on the other side is what we now looked at in terms of the governance. What will now happen from the side of the bank and then the government? We had this kind of messages which I received because I subscribe to email alerts. And so, but those who are illiterate do not have access to this kind of information, and the content is telling you about the awareness of the type of fraud that is going on within the country, and then also from the insurance company, which I also have. And then you have issues of internal control within the banking system, where you cannot start a particular transaction and end it on your own without getting security clearance from a superior officer. We also have processes that are laid down for them to investigate fraud cases within the banking system. And then you have issue about hot listing, where customers, once you are a victim of a particular fraud, you cannot list your account and nothing will done. Then we have these probing questions following what we found from the field. Can the understanding of moral economy be incorporated in financial product design? How do we build our trust in a web of insecurity in financial transactions? And then how do we carry out financial literacy based on customer characterization? And then going forward, we still have to do our quantitative aspect of the data collection, more interviews with the victims, and then with the governance. Interestingly, as I wind down on this presentation, is this that came on board when this BVN fraud came on board. And this is the traditional saving box, which we call traditionally Kolo. And then online, people were using it as their DP when the problem came. And from the message, they said, the only reliable and guaranteed bank, no BVN, no token, no KYC. Just break it down whenever you need your funds. And it shows the difficulty that people are facing, particularly those that could not successfully migrate and understand the new system that we are bringing on board. Thank you for listening.
Thank you very much. All right, so now we're going to hear, Janaki, are you speaking first?
I am.
Okay, so we'll hear first from Elisa Oreglia, who's with SOAS of University of London. She'll be speaking about Myanmar. And then we'll hear from Janaki Srinivasan, who's with the International Institute of IT in Bangalore. Ladies, you have up to 20 minutes.
All right, so I should start by saying that we have most of our field work ahead of us. And so here we're really presenting the questions we have, how we're thinking about these issues, and we're really looking for feedback from you. Rather than trying to persuade you of the sound logic of an Italian and an Indian scholar looking at intermediaries and cash in fisheries in India and agricultural market in Myanmar, let me just jump to an example that hopefully will bring to light what is that we're really looking at in this comparison light. So this is a tea trader from the northern part of Myanmar, the Shan state. And so she, has been born in a village where tea was grown, now lives in the town. She goes and buys tea from the villagers and then sells it to the town and to other towns. And, in many ways, she is the kind of intermediary that is often portrayed as the bad guy in agricultural markets. So it's the kind of intermediary who takes advantage fundamentally of farmers who might be too ignorant to know that there are better prices in other places, who cannot travel to other places, etc. And if you read at the quote, that kind of reinforces the idea of taking advantages, because she says, well, we go to the village when farmers are really down. They don't have money, they need money, so we give them money, we give them rice, we give them clothes, and then when harvest comes, they have to sell to us, they're indebted to us. Intermediaries as the bad people. But in fact, of course, the story is much more complicated. More importantly, the story is that intermediaries and cash persist. So they continue to be even in environments where there are a lot of mobile phones, there is increasingly mobile money, and so there would be opportunities for people like the farmers to just skip the intermediaries and go directly to the market. And this is an issue that puzzles a lot of people. It's like the quote that really inspired our work. It's like, why do intermediaries persist even when doing the same operation, for example, with mobile money would be much faster, much cheaper, much safer if you do it by yourself? And so this quote really brought together some of the work that Janaki has done in the past in Kerala, also work that was supported by the IIITB, and some of the work that I was doing in Myanmar last year as mobile phones started to become widespread. And so we started thinking about this comparison between the two countries.
So, drawing on all the research that we had done, we had two sets of questions that really prompted the proposal that we submitted to IIITB. The first was, in markets that are dominated by intermediaries and cash, what value do these kinds of intermediaries bring to the market? Given that they persist, what value are they really bringing to the market? And if you look at the other side of that, what value are these transactions bringing to the lives of intermediaries? So we wanted to look at both these things. And because we believe and we have seen throughout yesterday and the earlier session, that this whole issue of value, right, is so historically dependent and situated in a place, we wanted to do this as a comparative analysis. What constitutes value in two different places? And we chose to pick India and Myanmar because they're very interesting countries in terms of the trajectory of digital platforms, I think. And what I mean by that is, like you heard Elisa say and Kate before when she introduced us, Myanmar, of course, has had the introduction of mobile phones only lately, and mobile money is just about taking off. The Indian case is very different, where mobile phones have been around for a long while. So in a sense, many more people are comfortable with using a phone. But mobile money is relatively recent. So given the sort of different historical trajectory of how these ICTs have traversed in these countries, what is it that intermediaries are able to do with them or not able to do with them? How do these ICTs add to value, disrupt value? These are the sorts of questions that are prompting the research that we are about to start. Like Elisa said, this summer is going to be a summer of fieldwork, and essentially we're going to be looking at intermediaries. I will be looking to a site that I had been to earlier in Kerala, looking at fishing communities and who are the kinds of intermediaries who are operating there, what role might mobile money play there. Elisa is going to return to Burma and look at agrarian trading communities and how they use or don't use mobile money. So the way we are going to structure the rest of this presentation, given we don't have great nuggets from fieldwork as of now, is we are first going to look at the regulatory environment in both the countries within which these intermediaries are operating. And then we are going to take you back to some of our own research which has which led us to these questions, and look at who are these intermediaries that we are talking about, right? And what are they doing in these markets and transactions? So, Elisa.
Okay, so very briefly, I just want to give you an idea of the historical legacies that shape both the situation in terms of financial environment in Myanmar or Burma nowadays, and in terms of information communication technology adoption and diffusion. So Burma, as it was known then, gained independence from the UK in 1948. In 1962, there is a coup by the military that starts this one-party military rule that lasts until 2010-11. So what's interesting here is that in 1962 and then again in 64 and 85, there is a demonetization of the Myanmar currency, the kyat. That means that banknotes are declared that they're no longer legal tender, and that happens from time to time. Usually there is a period of time when you can convert the currency that has been demonetized into one that still has legal tender. So that happened. Then suddenly in 1987, there is a demonetization which happens overnight without conversion. And so suddenly the government declares all banknotes that were worth 35, 45, and 75 kyats worthless. And only the 1, 5, and 10 kyat notes remain legal currency and legal tender. And so that, of course, wipes completely out the savings of the population, destroys the markets, sends the black market into overdrive, especially trade with illegal trade with bordering countries. And so, you can see how something like this really shaped the kind of trust that people might have or rather not have towards the institution. Following that demonetization, General Nguyen, who was at the head of the military junta, puts into circulation 2 new banknotes worth 45 and 90 kyat, allegedly on the advice of his fortune teller, because 9 was his lucky number, and so the new currency was to be divided by 9. So this is just an idea of what was the financial situation then. In 2010, there are new elections. There is a new partly civilian government in place, and a program of surprisingly serious reforms start, especially in the economy. And one of these reforms opens up the market of mobile communications. Up until then, there had just been one mobile phone provider, the state monopoly Myanmar Post and Telecommunication. And so as a result, SIM cards were extremely expensive and extremely rare. Extremely expensive, I mean, about 10 years ago, a SIM card in Myanmar cost about $5,000. And only 5 years ago, it was still something like $1,500. So these were really precious goods that were available only to few people. And as a result, Myanmar was really at the bottom of the adoption cycle of mobile phones everywhere in the world. Then suddenly with this liberalization, 2014, 2 new companies, Telenor and Ooredoo, start offering service in August. And the cost of SIM cards drops to $1.50, and so that really opens up the field to a whole host of new users. The new companies are also building their own network. This is taking time, so outside of cities is still very difficult to have good connectivity, but I think now statistics says that about 35 to 40% of people in Myanmar have a SIM card. And mobile money, as Kate was saying earlier, is something that has just been experimented with as pilot project, so it will be interesting to see if it's actually being used in the future.
In a lot of ways, the telecom story in India is sort of similar to Myanmar, except it happened a few decades ago. The economic reform program that was undertaken in 1991, following a balance of payments crisis, was what sort of started it off. In 94, the telecom sector was opened up to private players, and I'm sure especially this audience has heard a lot about the dizzying levels at which mobile phone uptake has taken place in India over the course of the last decade and a half. The second kind of regulatory scheme that we are interested in here is the regulation around mobile payment. And this again was something that came up yesterday, that it's a multiple set of bodies who are driving these guidelines, and that results also in a lot of confusion. But in general, as technology keeps changing, regulatory frameworks haven't necessarily kept up in a lot of ways. And one of the first things that happened in 2008 was the Reserve Bank of India comes out with guidelines for mobile payments. And a couple of things that happen is, we have heard often in this room around telecom-led versus bank-led models of payments. And in the Indian case, it was a bank-led model. So telecoms basically, telcos could not themselves offer these services. They had to tie up with a bank in order to do this. There were also other regulations around what you could do with a mobile wallet. Could you only put money into it? Could you also take money out of it? And all of this shaped how many people were actually ending up using it, even if they were comfortable with a mobile phone, had access to it, etc. More recently, just a couple of years back, some of these guidelines are getting revised. The Reserve Bank of India has now invited applications from more than banking entities. So even if you're not a bank, you could apply to be what is called a payment bank. And when you were a payment bank, this was different than the earlier model where you had to tie up with a bank. Even if you were a telco, you could offer some of these services. And it was only in 2015 that 11 such licenses have been granted out. So this is very much something that's going on right now in India. We don't actually know how this is going to pan out, what kinds of platforms these guys are going to come up with, and how people are going to pick up on them. But overall, the accessibility of some of these platforms seems to have opened up slightly over the course of the last 8-9 years when all these regulations have been sort of going on. Now, what sort of unites this entire 2008 onwards period, however, is the importance of someone we would call a mobile money agent or intermediary. And you can immediately see where the role for that person comes in, right? Right from loading cash onto a mobile platform to making payments through it. You're dealing with populations that a lot of times would not know how to do something like that, plus it's a new process. So given all of that, the importance of a mobile money agent as an intermediary is something that has stayed despite all the dizzying rate of change in the regulations themselves. So that's one kind of intermediary. And then looking more specifically at the case of Kerala, which is where I'm going to be doing fieldwork, and what are the kinds of intermediaries that have traditionally existed in the fishing markets of Kerala. And this goes back to some research that my co-researchers, Jenna Burrell, Richa Kumar, and I did in 2012 with IMTFI. And I'm going to revisit this study, which is essentially itself a revisit of economist Robert Jensen's work on fisheries and mobile phones. So basically what Robert Jensen was saying is he's talking about Kerala. He did survey work over a course of 5 years when he's looking at the introduction of mobile phones into these fish markets in northern Kerala. And his point is that there is, before mobile phones, there is someone you call a producer or a seller, who's essentially the fisherman who goes out to the sea, gets fish, and he's looking specifically at sardines, so he's getting sardine, which he then sells to a consumer or a buyer. And Jensen's entire focus here is on how the introduction of mobile phones into this scenario changes how people speak about and share price information, what that does to the price of fish, people's livelihoods, and so on. And we can get more into this in Q&A if you want. That is not necessarily what I'm focusing on here. Here, what I'm trying to do is to revisit some of the work that we did where we complicated all of these categories, right? So it wasn't just a producer, one type of fish, and a direct sale to a consumer. Instead, what we found in both North and South Kerala was that there were various categories of producers, right? You had really small fish, really small boats, to really big boats. And the difference in investment between these two was significant. It could be up to 10 to 12 times more, right? In terms of the craft and the that you took out to sea, as well as how much the operational costs were and so on. So you had various categories of producers. Now, given the kind of costs involved, and there were of course also various types of fish, the story of sardine is very different than, say, the story of a fish that you're going to export, right? So there is that complication. And then we found out that they weren't actually directly selling to a consumer at all. Instead, what you had was somebody who was investing in the boats, and in return for that got to auction the fish that the fishermen brought in, right? And in the course of the auction, they would then sell it to, again, various categories of buyers. And this is where issues of gender and religion also come in. The way this happens in the Christian South is very different than the Muslim North, and so on and so forth. Now, coming back to the investor auctioneer, he's in a way the typical middleman that we have been talking about, right? It's the person that everyone wants to remove. But what is the history of the middleman in this particular case? And what we found was really interesting, because it drew on Kerala's political history and the kind of collective organization that fishermen in the region were involved in. So before this kind of an auctioning system, what was essentially going on was there was somebody who was giving out loans to the fishermen, and in return for that, it was a fairly exploitative relationship where you had to sell your fish back to the person who gave you the loan to buy the equipment, right? And then historically, many other things also happened. The market was trying to do more exports. There was overfishing. So for a variety of reasons, a very strong collective movement and organization grew in Kerala over the 60s and the 70s. And by the end of the 70s, one of the things they had come up with was fishing co-ops. And this investor would essentially be the fishing co-op, and the auctioneer would be someone that was paid by the co-op to get the best possible price for the fish. So this is how the auctioning system sort of got systematized in the 80s. Over time, of course, the investors are no longer only co-ops, but the system of a transparent auction has been more or less set up now. If we go back to the issue of trust, it's a system that people have come to recognize and trust. And it is in this that we have to, it's against this backdrop that we have to understand this particular middleman. What does this have to do with technology? Now, in this market, a lot of people might or might not have mobile phones, but the auctioneer always did. And the way these things happened was the fishermen would come in from the sea. They would call up the auctioneer to make sure that the auctioneer was available at the market to sell their fish for them. The auctioneer would be standing there, would auction out the fish. Once the price and the buyer was decided, they would just take the cash from them, add it to the wad of notes that they already had in their sarong or lungi, and then give out some of that to the fishermen. And sometimes this was settled daily, sometimes this was settled weekly. So you see how both the cash as well as this auctioneer are critical to how this market functions, right? And when I was here in 2012, there was no mobile money to speak of because of all the regulations that I've been talking about. But what would be interesting would be to revisit and see then how this intermediary deals with that kind of a new platform. Those were some extra actors in case that wasn't complex enough.
Okay, so moving on to Myanmar. My field site, as I said, is in the north in Shan State, which is an area where there are a lot of ethnic minorities. And I look at a small market town where, again, a lot of minorities are represented. So Burmese, but also Burmese Chinese, Burmese Indian, all different religions, Muslim, Buddhist, Christians, and a lot of tribal people. And the market is where farmers from nearby come to sell or buy, but there is also a lot of trade with the rest of the country and with neighboring countries such as China and Thailand. And I'm looking specifically at agricultural products. And here was, just to leave you a little bit of the roughness of field notes. This is how I was trying to map out some of the intermediaries in financial transactions. And again, this is when the phones were this was just last year, so phones were really still a new thing, and they were used a little bit for coordination, but not for any kind of financial transaction. And so I was trying to see how money travels. And so, you have the market, and then you have the bus networks. And I think a few people have mentioned how people give money to bus drivers to send money back to their family and so forth. Here it was a matter of sellers or buyers giving money to bus drivers to bring to sellers or buyers in other places. It turned out that even though people had this image of cash traveling with bus driver, cash was not traveling, in fact. It was more the bus company that had offices in different towns, and they would just make a phone call on the landline, and then once a week, more or less, they would reconcile the accounts between the different agencies. And then at that point, they would do a bank transfer to, just pair up. So the other interesting thing was in terms of financial movement was small traders who tended to borrow money from their family members when they needed to expand their business or they were in debt. There was a co-op for savings that was used mostly by women trader. The bank was something that just started literally last year. Again, it's a country that is building all this kind of infrastructure. And so it's just coming together. And finally, there was the goldsmiths that were all around the market, and they sold gold jewelry, but in fact, they had served for a very long time as the financial office of the town, because farmers would buy gold as soon as they had sold their crops, and it was a more stable way of saving their money. I mean, seeing what happened to the currency, that was a very wise decision. And goldsmith tended to be Chinese Burmese, and so here we have an idea of ethnicity. So the Chinese Burmese were the ethnicity that did business with everybody, and everybody did business with them. And here there's an interesting issue between loyalty and trust. The recent report of the IIITB said that, be careful, trust is not necessarily loyalty, but here it's also the reverse is also true. So loyalty is not necessarily trust. A lot of people did business with people and they said, we're loyal, but they didn't necessarily trust them. And in fact, we're quite aware that they were not really treated correctly. So here is just to recap some of the characteristics of these traders, these intermediaries. And at some point, we would expect some of the findings from Myanmar and from India to kind of overlap the two fields, and to see how mobile phones in Myanmar and mobile phones and mobile money, especially in India, what role they will play there. And finally, these are basically our next steps in terms of fieldwork, going back to the site, focus more on the different types of intermediaries, and again, on the value that they bring to the transactions. And we're really keen on, we already heard some of the presentations that have some areas that overlap with ours, and so we'd be interested in hearing more from other IIITB-supported projects, for ideas on methods, but also possible collaborations to just rescue the intermediaries from, the disdain, the contempt they're held into. Thanks.
Okay, great. Terrific presentations. I'm sure there are lots of questions. What I want to suggest, because we have Maria Elisa on the Skype, I think. There she is. Yes, welcome, Maria Elisa. I hope you could hear the presentations all right. And I'm going to first invite a few questions to Maria Elisa and Andrea, and then we'll open it up more widely. So who has a question they'd like to ask about the Colombian context of family social protection, state social protection, how technology is affecting trust and transfers, and so on? Questions from the floor? Yes, we've got one here, and where's another? Yes? All right, then I have one. Go ahead.
All right, wonderful presentation. As you were saying, in Colombia, the situation, there has been actually this 60-year-long civil war going on. So I just want to know if you can elaborate a little bit on this crisis situation and how technology is going to, fix or give some kind of confidence to people who are living in these very difficult times. Do you think technology plays a powerful role here?
Okay, so yours is a bit of a prediction question, and mine is as well, to Maria, Elisa, and Andrea, where you make the important observation, I think, that so far the mobile money has been sort of imposed by the state as a solution in the social protection sphere. You haven't yet seen spillover into its use more for a wider range of financial services. What's your prediction, and what role do you think trust building plays in that? So let's start with those two questions. Maria, Elisa, I believe you're going to take the lead on fielding questions.
I'm sorry, I didn't understand well the first question that was asked. Could you repeat it because you have the microphone there?
Oh, sure. Yes, it might be hard to hear things from the floor. So the question was basically in a, and I'll try to do justice to this, in a conflict and immediate post-conflict, traumatic setting, what are your perspectives on how technology might be helpful? Does that capture the essence of it? Okay.
I'm sorry, I don't hear you. The sound is falling. So maybe Andrea can answer it.
Okay, Andrea, you were hoping this was the easy part. You got through your presentation and it's almost coffee break, but you're on.
Thank you. Well, for the moment, we see that families doesn't use mobile money, at least, other that for collect the government payments. So technology is very broad. I don't know what role it can play, but for the moment we're interested in understanding why they don't use mobile money for other things that collect government payments. I think personally that kind of technology can help a lot of, because to send money with other people or to send money through traditional intermediaries is or risky or it is expensive. So it could play a good role, but we should understand which are the challenges in this regard. So.
All right, you're not quite off the hook yet. I want you to spell out a little
Okay.
bit more. What, from your findings so far on trust,
Yeah.
what will build trust, or what are the trust barriers at the moment to what you're predicting will happen?
Okay, what is the
What
trust
will
challenge?
build, what are the
Okay.
trust challenges or optimistic?
Okay, I think that is quite technical at the moment. The thing of trust is that mobile money doesn't function every time. And personally, I use sometimes when for example, once I lose my debit card and I used to use mobile money, and it keeps me sometimes like 2 hours be available to withdraw the money. So for the moment, I think it's mostly technical. For me, for people like me, for other people, they know that it's difficult. And for the moment, I think that is the principal reason. Yeah.
Great. So this distinction between knowing how it works
Yeah.
versus whether it will work. And we did global work on problems of digital finance customers and found reliability of the network and agents actually having cash were the number 1 and 2 things that were keeping people from taking up and transacting. So very real situation. All right, let's take some questions then for the whole panel or specific panelists. Maybe we'll do like yesterday, take three questions or comments.
And let's see, I've got one here. I can't tell Sonia whether you are signaling. Sonia, I've got another. And is there a third person who'd like to make a comment or ask a question? Here, okay, please.
I have a question for Janaki and the other principal investigator. There is some commonality between the example of tea selling and the fish market there. My question is like this. Probably the fundamental problem remains as market linkage. So that the arrangements you talked about looks like a kind of buyback or dealing arrangements. Because, the investor, be it the auctioneer or some kind of collector who comes back and then again takes back the produce. So I would like to know how a payment practice is going to change this market linkage. Because I think the whole of India, whether it is agricultural goods and all that, market linkage still remains as a problem. And I think the root cause might be access to credit, or even if there is access to credit, I think these people believe more in the traditional arrangements like this. But how is use of mobile money going to sort of enhance this market linkage or change this fundamental problem? Thank you.
Thanks. Sonia?
Thank you. Thanks a lot for the presentations. My question goes to Maria and Andrea. It's regarding Colombia has launched this government payments Davi Plata that, so to what extent do you think the collaboration or lack thereof and these fragmentations of initiative in the market is affecting customer trust and adoption? Just to clarify it, we're talking about government payments or these social transfers, but at the same time, there are initiatives in the country from like different banking associations or microfinance institutions deploying agent networks, and that in some cases are isolated, or you go to one place and cannot transact if you are a client of another institution. So I just wanted to get your takeaways on what's going on in the country. Thanks.
We need a microphone up here. Sorry. Oh, do we just have one mic that's running around? Oh, all right. Great. I'm gonna.
Hi. Do you listen to? Can you hear me? Yeah.
Yes.
Because that one I did hear. So
Okay, great. We will, in just a moment, we're going to ask you to take that question. And gentlemen over here, for geographic reasons, may I take this question and then we'll take you in the next round? Yes? Okay, please.
Okay, thank you. So I have a question for the team in the University of Ibadan. So it was interesting how one of your last slides was, well, let's not trust banks. Let's go back to, just a piggy bank or traditional forms. But clearly, despite the distrust, people still use banks. So I wonder if you can speak more about why people, what are the incentives for people to use banks, to just spell it out more clearly despite the distrust? Who are the kinds of people who use banks? And I wonder if we can link this to Janaki and Elisa's wonderful presentation about loyalty and trust. Because at least in my research in Indonesia, I saw that even though people distrusted institutions, recruitment agents, they still remained loyal because of the absence of alternatives. So I wonder if you can speak more about that relationship as well. Thank you.
Okay, great. We've got a wide range of topics for the questions. So Maria, Elisa, you can speak to any of those questions, but particularly Sonia's.
Thank you. With regards to what's happening in Colombia now, there's been changes in regulation so that it's not only the bank-led model that we've had so far, but also licenses to other agents, and we are still to know how that's going to play out. But from the point of view of the government, even if they understand the importance of transactability between different agents, they are not doing much yet. They did put in the regulation that the platform should be open to everyone, but it's not like they're enforcing it. So for now, it's too soon to expect large changes. What's happening, going back to what we have now, which is mostly the bank-led model, especially in these areas, that they arrive through intermediaries, in this sense, bank intermediaries that change very often, and also with tenders at the national level for the distribution of the cash transfers. These also change a lot. So what happens to the population in these areas is that they don't know who they're dealing with, because intermediaries change, because practices change. So there's a part of it that has to do with knowledge. Knowledge is an issue in adoption, because they don't know who they're dealing with and what they have to do. But even in parts that are more stable, like our site in the north, usually what happens is that even if they know how they work, they still want the cash because of issues of availability. Sometimes it's because of connectivity. Sometimes it's because the cash transfers arrive in peaks, because a lot of people are receiving cash transfers at the same time, and they actually want to hold on to the cash. Because as Andrea spoke earlier, money is scarce. So when you have it, it's very important not to lose it because there's a connectivity issue at the last moment, or issues like this. So there are definitely issues of trust, even in parts where they have been accustomed to receiving the cash transfers for now 2 or 3 years. It's still a matter of they're not being comfortable with how they treat even their amounts of money. Sometimes it's just because if you have a little money, you have 15,000 pesos, and they only allow you 10 or 20,000 pesos to transact. The 5,000 pesos differences is very relevant. So I hope I partly answered your question, because I don't know if you're hearing me right.
No, we could actually hear you very well, and that was terrific. Thank you very much. I'm going to suggest now that we go to then Janaki, and it was a question about, in a way, about like bundled, the finance is bundled with other services, and how does that affect trust, loyalty, options?
Can you hear me? Yeah. I'm not going to attempt to predict how mobile money is going to shape these linkages, because the interesting thing about Kerala is also that they do have access to banks. So there might be other reasons for which they might pick this up, but I'm not sure how it will integrate. But in terms of the buyback, I think we need to look at this slightly more broadly. And what I was trying to say was that before the auctioning system, it was actually exactly the way you described it. You give someone money, they buy the equipment, they have to sell back to you. But the auctioning system that's been put in place actually does open up the market a bit more for the sellers, in the sense that the auctioneer does conduct a public auction, which happens in front of you. It does actually happen publicly, where you have multiple buyers who might want to buy it. So in that sense, I don't think there is a lack of linkages. So it's more a problem of what kind of linkages you have. And to me, the fact that it's a traditional arrangement and possibly not formalized in the sense of contracts doesn't necessarily make it less valuable, right? And especially if you go back in Kerala's history, it was in fact an attempt to link more to export markets through the 60s and 70s. That has actually resulted in a lot of the problems that the fishing industry is looking at today. So I think it's important to not just focus on how many linkages you have, but what kinds of linkages you have and what are sort of the power relations within that. So I think it's within that sort of backdrop that we'll have to see how mobile money is taken up.
Okay, did you want to add?
Yes,
Yeah,
I wanted to add, the example of the tea traders. That is a very straightforward buyback program that relied on the fact that farmers did not really have many choices, and the technology that changed things for many of these villages that are quite hard to access was in fact the motorbike. So a couple of years ago they started importing cheap motorbikes from China, and that allowed some of the farmers to go to nearby villages or go to the town, and then have access to other lines of credits, or get to their relatives in other villages and borrow money from them, etc. But there are still people who, despite the fact that they have more choices, still rely on these traders. And I think, and that's definitely something that I'm keen to explore, that ethnicity, so ethnic ties, have a really big part to play in this. So it's like trust and loyalty and ethnic ties intermix in an interesting way.
Thank you. Can we hear then from Dio and Tosi? So you got a question about, do people trust banks? Why do they trust banks? How has technology affected that? And in this context you've described of fraud and financial crime being relatively prevalent.
Yeah, okay, quickly, maybe I would try and maybe take the easier questions and then push
Excellent strategy.
the more difficult
Go
ones
first
to dive. All right. So in terms of why do people use banks and who actually uses banks, I think that's linked to sometimes in specific context what you mean when you think about the unbanked, for instance. So there might be a big difference in certain settings with people who have things like formal bank accounts, and then maybe a much wider population that interfaces with the banks in certain ways. For instance, in a number of local markets around Oyo and Ogun states that I know well about, they have these guys who go around the market to collect daily contributions from traders. Okay, so the traders themselves don't go to the banks. Okay, but eventually, where does the guy take the money to? Probably deposits it in the bank. Okay, eventually. So sometimes it's not exactly clear when you say who uses the bank. Okay, there are those who use directly, and then there are those who use in other forms or interface with the financial systems in other forms. For the people that use banks, you find people across different categories using banks. So it's not exactly that everybody who goes to the bank is literate. There are so many other groups, informal associations and co, that have formal accounts with banks and have signatories who then can make withdrawals on behalf of the group. Okay, even in cases where people can't even actually sign their signatures, they can use their thumbprints and things like that to get withdrawals. So those are not very clear categorizations to make in certain cases. So maybe that I would speak about trust and loyalty. I don't know where to draw the lines, really.
Anyway, thank you. In terms of the use, insight from the field indicated that when people were not so much into formal banking services, people were keeping money in their homes. For instance, the last slide that I showed, it's increased physical attacks, armed robberies at homes, and people were losing not only their monies, but also their lives, properties. People get raped and the rest of them. So they transfer this risk to the formal banking and to reduce that pressure on them. And so you keep this money for me. But transferring that particular risk to the formal banking sector by different categories of people. For instance, a student would open an account because there is always an account for student account that is opened. It enables you to quickly receive money from home. People send money to you. In those days, people would travel miles to get money. You get home and there is no money. And so it's a loss on both sides. And so it makes more sense for students to open accounts so that at least you get alert and you know that it's money in your account, then you make withdrawals. So for different categories of individuals, they have this. But what Tosin was trying to make allusion to has to do with those that we say are in the informal economy and we want to bring them on board. There's so much trust these people who collect money and then take it to the formal banking to save. Because when they need, you were talking about incentives that people, when you take your money there, when they need money to transact their business, these people make monies available for them. They bring it to them in the marketplace. These same categories of people will not have that opportunity when they go to the formal banking. They deal with social class issues, collateral issues that will send those that are not the huge customers away. They will deal with more big guys who have this, who have that, certainty, and where they can also get more interest on the loans that they are giving out. And so those people that are in the informal economy that we are trying to bring on board, we need to design. That is why we are saying that we need to do some design packages that addresses customer characterizations. So if you know that this is what they need, you should make something for them, and they can be well incorporated.
Thank you so much. All right, we are sadly at the end of our session. However, and I need to keep your trust by letting you get coffee. However, this gentleman was patient, and I need to keep his trust, so he gets to state his question or make his comment if he wishes. I've just actually, yes, I know, I put you in an intentionally difficult situation. He's first in line if he has a question on the next session. Please join me in thanking our superb panelists. And Maria Elisa, thank you for your patience in persevering through, and we wish you all good success with your baby. So thank you all.